Good afternoon. Thank you for joining us today. My name is Steve Wolfenbarger, and I am the Education Manager for AHOA. We are happy to welcome Paul DiNardo. He specializes in succession planning for business owners, structuring incentive-based executive compensation plans, business merger and acquisitions, corporate, partnership, and joint venture taxation. He has also co-authored a real estate tax-specific industry book for Commerce Clearinghouse, The Practical Guide to Cost Segregation. Now, before handing this over to Paul, I would like to read this disclaimer for all those listening to this presentation. AHOA does not provide legal or business advice or representation to any individual persons or members. AHOA goes to great lengths to ensure the information it provides is accurate and useful, but strongly recommends all persons obtain professional advice and or legal representation which is appropriate to their particular situation. Further, AHOA does not endorse any companies nor any of the products or services they offer. There will be a Q&A available at the end of this presentation. For any questions you may have, please type them in the question section. Also, we will make today's presentation available for all within 48 hours. We are excited to have you all here today, so with no further delay, I welcome Paul to begin.
Thanks, Steve, and good afternoon, everybody. Thank you for having me. Before I begin, the headline or the title of this presentation is Partnerships versus S Corporations, Why It Matters. Briefly, it's important to know when I talk about partnerships, what I'm also talking about are LLCs that are taxed as partnerships. So LLCs can be taxed as S corporations, or LLCs can be taxed as partnerships. So when you hear me use the term partnerships, what I'm really referring to are general partnerships, limited partnerships, or even limited liability companies that are taxed as partnerships. So for purposes of this discussion, partnerships also equals LLC. S corporations are a different type of entity. And so why does it matter when we talk about LLCs and S corporations? I'm going to talk just a minute about basis and explain why it does matter. So what basis allows each of us to do, it allows us as investors in deals to take tax-free distributions and in some cases tax losses in excess of investor cash in the deal. So if I put $100 of equity into a deal and I borrow $900, if you're an LLC, you can create basis of $100 or $1,000 in that case. In the case of an S corporation, your basis is going to be limited to the $100 of investment. I'll get into that in a little bit more detail in a minute. What basis also allows us to do is it allows real estate investors to create massive portfolios while legally sheltering taxable income through cost segregation studies. So those of you who don't know what a cost segregation study is, I'm going to touch briefly upon that because the two go hand in glove. A cost segregation study, in short, is an engineering-based analysis of a building, the goal of which is to allocate as much cost as possible to assets with the shortest depreciable life. So what we're able to do, we're actually able to mismatch cash flow and tax deductions, and I'll be talking about that a little bit as well. So things that create basis, we should think of basis as a piggy bank of economic risk. So the IRS says, okay, investor, you can take out distributions and you can take losses to the extent that you have economic risk. And so the definition of economic risk is any money I contribute to an entity, the basis of any property I contribute. So if I have a building I paid $1 million for, regardless of even if it's worth $2 or $3 million, I contribute that. I get economic credit for the $1 million of basis that I contribute to the property. Money I directly loan to my venture. So if I stroke an entity a check for $100,000 as a loan, I get credit for that. If the entity makes a profit and does not distribute that cash, that's an increase in basis as well, because the IRS says, well, now you've got more economic risk because you pay tax on money you haven't gotten yet. Guaranteeing debt, so if the bank comes to me and says, Paul, we want your guarantee on this loan, in certain cases, it increases my basis. And in other cases, it won't, and I'll get into that in a little bit. This last part is kind of important. There's a term that maybe many of you have heard, and it's called qualified non-recourse debt financing. And if we walk through what that means is, first of all, it's a non-recourse debt, which means it's financing where no one is personally liable. It's borrowed for use in a real estate venture, and it's borrowed from a qualified person, and that means one who is regularly engaged in real estate lending. So where this came from is back in 1986 when they changed the rules, they started creating passive losses and active losses, and they said, look, if you haven't guaranteed a debt, the IRS says that you're not personally at risk for that. You don't get credit for that. Well, the real estate community was up in arms and said, wait a minute, if I have a leveraged building, I am at risk. Even though I'm not personally at risk on the loan, I'm personally at risk for the underlying investment. So the IRS carved out an exception and said, if you're a real estate investor and you have a loan that meets this standard, in other words, you can't have it borrowed from a family member or somebody else, then even though you may not be personally liable on it and it's non-recourse, as long as it's qualified, you'll get credit for that economic basis. So you can take distributions out against that. You may have heard the term debt finance distribution. If I refinance my property and it's in an LLC, I can take out those distributions tax-free. Not so much in an S corporation. And I'll get to that in just in a second. So if we look at the things that create basis, we have to look at what reduces basis. And just like money contributed to an entity increases basis, money distributed from an entity decreases basis. If I incur non-deductible expenses in my LLC or my S corp, that would reduce basis as well. If I receive a distribution, just like I got credit for a contribution going into the entity, I have to get hit for a distribution. Now, the rules on distributions, and I'll get into this in a second, are vastly different for LLCs and S corporations. An LLC, if I receive an asset that's distributed to me, it's merely a transfer of basis. If I receive an asset that's distributed to me from an S corporation, then it's a deemed sale at fair market value to the owner of the S corporation. So if I had to have an alternative name for this presentation, it would be real estate should never, ever, 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 ever be in an S corporation. Simply because if I take a distribution out of an S corporation, the IRS says what I've basically done is I've sold the asset at fair market value to myself, and I have to pay tax. So the fair market value of basis or property distributed reduces my economic risk. The repayment of money that I loaned, right? I get credit for loaning money to the entity. That basis gets reduced when it pays me back. If I have taxable profits that are distributed, my basis goes down. If I have personally guaranteed debt, the IRS says, okay, that's economic risk, but that's only for an LLC and not an S corporation. I'll get into that in a second as well. And then repayment of qualified non-recourse debt financing. So just like we got credit for economic risk when we took out a non-recourse, qualified non-recourse loan, then we take a hit when that debt gets paid back. So if we take, I'm going to walk through each of these items and talk just for a minute about the impact between LLC and S corporation. So and again, these are LLCs taxed as partnerships versus S corporations. So if I contribute money to an LLC or S corp, I get basis. If I contribute property, I get basis for the basis of the property contributed. If I loan money, I get basis under both entities. Taxable profits not distributed increases basis under each entity. If I guarantee debt, IRS says I have economic risk in an LLC. An S corporation, the answer is no. So if I own an S corporation and the bank loans the company $1 million, and the bank says, Paul, I want you to guarantee the debt, and I guarantee the debt, the IRS says, even though I'm personally liable on that $1 million, because it's an S corporation, I don't get credit for it. Okay? And then qualified non-recourse debt financing, the same thing. I get economic risk under an LLC. The S corporation is because it's a corporate entity, I don't get economic risk. I don't get no credit for economic risk. So in a situation where I invest $100 and let's say I invest $1 million and I borrow $9 million to buy a $10 million building, in an LLC my basis is $10 million, in an S corporation my basis is only $1 million. And that basis limits you as to how much money you can pull out or how much you can take in tax losses. So it's a significantly limiting factor. If we take a look at items that reduce basis, again, money distributed, that reduces basis for both LLCs and S corporations. Non-deductible expenses reduces basis. The fair market value of property distributed. So for an LLC, the property comes out and is just a transfer of basis. For an S corporation, there's a deemed sale at fair market value, so you have a taxable gain. So LLCs and partnerships are very easy to slide assets in. It's kind of kind of a semi-permeable membrane, if you will. You can put assets in and take them out and transfer basis in and out. With an S corporation, it's permanent. Once it goes in, if you try to get it out through a distribution, the IRS says, nope, you sold it yourself and you got taxable gain. If there's repayment of money I've loaned to the entity, that reduces my basis. If I've got taxable profits distributed, it reduces basis for both of them. Eliminated personal guarantee. So on an LLC, if the bank says, I'm loaning your company $1 million, Paul, but I want you to guarantee it, I get economic basis for a limit for guaranteeing that loan. In 2 or 3 years, if the company's doing really well and the bank says, hey, Paul, you no longer need to guarantee the loan and my guarantee is removed, that basis disappears. That's not so for S corporations because I never got credit for the economic basis, right? You remember, if I guarantee a loan for an S corp, that doesn't give me basis. And so the elimination of a personal guarantee does not reduce basis. And repayment of qualified non-recourse debt financing reduces my basis in an LLC or partnership, and it has no impact on an S corp because I get no credit for the basis to begin with. So how does an S corp owner receive economic credit for bank debt? And this is statutory. This is something that's very clear in the Internal Revenue Code how you do this. The only way for an S corporation owner to receive basis for bank debt is for the bank to loan the money directly to the owner, and then the owner loans the money to the company. So you can imagine how convoluted that is when the bank wants to secure a loan for a real estate transaction for an entity that's an S corp, because the S corp owns the real estate, but they've got to have you on the note. It really confuses stuff. And so the only way you can get economic credit is if literally the check goes from the bank to you, and now you owe the bank the money, and you turn around and you loan the money to your business, and now the business owes you the money. So that's why we don't like work. That's one of the reasons we don't like working with S corporations. So the next thing I want to talk about briefly is how earnings are taxed. So earnings from an S corporation are not subject to self-employment tax. So self-employment tax is 15.3%. I'm going to assume you know what payroll taxes are. So it's about $120,000, and then another 2.9% on anything above that. So S corporations, is clear by statute that if you have an S corporation and it has a business, that the owner of the business, if it works for the business, receives a W-2, and that W-2 they pay taxes on. The distribution it takes are not subject to self-employment tax. It is one of the advantages over an LLC. Earnings from an LLC in which an active trader business resides are likely subject to self-employment tax. So the IRS is taking the position that if I own an LLC that I'm actively involved with managing, then all the income from that LLC is considered self-employment income. So there could be an additional payroll tax on top of that. So what we do for our clients is we typically set up the real estate in an LLC, and then we set up the operating companies in an S corporation, right? Because the operating companies doesn't own any real estate; it just owns the operations, maybe some computers and the employees, and then the LLCs pay a management fee to the S corporation. That does a couple of things. It keeps the LLC income as not subject to SE tax because it's not a trader business, since we're actually operating the S corporation, and it also allows the S corporation to receive the management fees, pay the manager a salary, and escape employment tax on the excess earnings. So what I want to do is I want to walk you through real quick. This is an actual PPM. PPM is a private placement memorandum. So we deal a lot with real estate businesses, and we have clients that invest, and we have clients that are looking for money, and they'll put together these PPMs that show a lot about the entity, the real estate, where it is. They'll have, they'll do a study about comparables in the area. It'll be probably a 40 or 50 page document. And one of the areas they'll have a section for finance. What do we expect the cash flow to look like? And these are actual numbers. So in 2018, they're saying, okay, we're going to have operating income of $492,753. Okay, and so across the top, we've got 18, 19, 20, 21. So for the first 4 years, we're going to generate about $2,200,000 in operating income. If we go down the left, we got $492,000 the first year. We're going to have a net cash flow after debt service of $222,255. So we made $492,000. We paid our debt service. We still have $222,000 of cash flow that's available. If we look at a cost segregation study, we're able to generate $530,000 of tax deductions. So in year one, even though we generated $222,000 of cash flow, we generated a tax loss for our investors of $38,000. In the second year, we make $534,000. Our net cash flow after debt service is almost $300,000. Yet we're able to generate $750,000 of deductions for a net tax deduction for $216,000. So here's a situation we've generated over $500,000 of cash flow and still haven't paid any taxes yet. Matter of fact, we've been generating tax losses. So if we look at the end of year 4, we've generated $2.2 million in operating income. We have cash flow of $1.1 million. We've generated deductions of $2.2 million. So even though we've generated well north of $1 million of cash flow, we have generated no taxable income in the entity. So I've got clients who've literally started their business by buying a strip shopping center back in the mid-90s. And they use this technique to shelter the income for the first 4 years, and they'll use that cash flow to then invest in the next deal and the next deal, and we'll layer these deals on top of each other. And in one case, the company is probably in charge of several $100 billion worth of real estate now. We've done cost segregation studies on 1 million square foot high rises in some of the largest cities in the country. And they're able to really manage their tax liability because we got a significant mismatch of tax deductions and cash flow. And the reason I tell you this is because, remember, we can only take these tax losses to the extent we have economic risk. And if you have an S corporation, your economic risk is limited to what money you put in the deal. If I have an LLC, I get economic risk for all the debt. For any debt that's in any qualified non-recourse debt that's in the entity, I get economic credit for that. And what that means is I can do two things. I can take losses and I can take distributions tax-free. Not so with S corporations. So just give you an example here. Harvey buys $1 million hotel. He invests $100,000 personally and borrows $900 from a bank. The property generates $50,000 of cash flow each year for 5 years, and it generates tax losses of $40,000 each for 5 years. So in year 6, the property is worth $2 million. The debt is only $750 at that point, but we say, hey, the property's worth $2 million. Let's go ahead and refinance it. So now we go out and we go to the bank, and the bank gives us qualified non-recourse debt of $1,750,000. So now we have $1 million that we can distribute, right? And so just to walk through that again, we've had a property 6 years. It's appreciated from $1 million to $2 million. Our debt is $750,000, and we decided that we can refinance it for $1,750,000. So then we take this $1 million and we distribute it out. So what's the treatment under an LLC or an S corporation? So under an LLC, step one would be, what's the deal with the cash flow? The cash flow is sheltered under each scenario because we can take losses in either scenario up to our cash flow. So while the cash flow is sheltered, the excess losses are not deductible under the S corporation scenario. So what that means is, under either scenario, all cash flow is sheltered down to zero income. But if we have an LLC, we have economic risk of that additional basis, and we can take the losses against other income. Under the S corp, we can only take losses up to our initial $100,000 we put in, right? Because we're an S corp, we only get economic risk for the money we put into the S corp. So under the LLC, I can deduct all $200,000 of losses. In the S corp, I'm limited to what I put in. Now, here's the real rub, and here's why I do not like S corporations when it comes to real estate. The $1 million of debt finance distributions, the LLC, you can distribute that tax-free to the owners, right? Because remember, we can take distributions to the extent we have economic risk, and qualified non-recourse debt financing gives us economic risk. Under an S corporation, the S corporation does not allow, again, we can only get distributions from an S corp to the extent we have economic risk, and our economic risk is limited to the cash we put in. So if we distribute that $1 million, we've triggered taxable income to the S corp, we trigger taxable income to the owner of the S corp. It's going to be considered a capital gain distribution. The only way to avoid that, and I have a couple of clients that have very old S corporations that have real estate, and they've refinanced the property a few times. Instead of treating it as a distribution to the owner, we have to treat it as a loan to the owner. So we have one client that has over $10 million of loans that's taken out from the S corp because every 2 or 3 years the property appreciates and the bank's willing to lend them more money, and the owners refinance and they want to pull the money out. But if we treat it as a distribution out of the S corp, it's going to trigger an unnecessary tax, capital gain tax. So we treat it as a loan to them, And now we've got to track these loans, right? We have a loan from the bank to the S corp, and now the S corp has loaned money from itself to the individual. And the risk is the IRS comes in and says, you know what we really have here? What we have is we've got an owner who really hasn't borrowed money from his entity. He's really taken a distribution, and because it's an S corp, we're going to tax it. And that's one of the things that keeps me up at night is this client that we've taken the position that, hey, this money he's pulled out over the last 15 years is a loan, when really the IRS could say it's a distribution. They said, look, you haven't paid any of it back. And then we have to accrue interest on top of that. We have over $1 million of accrued interest because, of course, if it's a loan, you're required to accrue interest and treat it like a loan. And so we have this huge loan in the books to the shareholder. We have this huge interest accrual, and we still have the risk that the service comes in and goes, you know what, it's really not a loan, it's really a distribution. And because it came out of an S corporation, it's subject to taxation. So the only way to avoid taxes on the S corp distribution is for the S corp to loan proceeds to the S corp owner, which we talked about. The loan must be back-to-back between the bank, the S corporation, and the S corp owner. So getting back to, if a bank is willing to lend my S corporation money, how do I get economic credit for that? It only works if you do a back-to-back loan, corporation or a bank to individual owner, and an individual owner to S corporation. So the note between the owner and the company must be made and interest must be charged. Now, we do have some operating businesses that operate as S corporations, and they do need to borrow money from time to time, and we would like the owners to take their losses. So in that situation, when there's not collateral, there's not a security interest in real estate, the more sophisticated banks understand why you have to loan the money to the owner, and then the owner loans the money to the corporation, and we just do back-to-back reciprocal loans with the same interest rate. So whatever interest he's being charged, he charges his company and back and forth. So in an S-corp environment, a note between the owner and the company must be made, and interest must be charged. Otherwise, they're going to say it's really not a loan, it's really a distribution. And the compounding of interest adds up over time. I'm thinking this one client I have with $10 million in loans has millions of dollars of accrued but unpaid interest. The loan to shareholder never leaves the books until the property is sold or until the IRS comes along and says, well, it's really not a loan, it's a distribution. And they'll take it off your books because they'll say it's income to you, and then you got to pay capital gain on that, on money that you've probably already spent. And there is a push with the IRS they're beginning to scrutinize S-corp loans, and there's risk that the IRS takes this loan as a taxable dividend. I kind of beat that to death a little bit, but we're seeing the IRS really start to focus on S-corp loans because there's another problem with S-corps. I could go on and on about problems with S-corps. One of the other challenges is that whatever the ownership is of an S-corp, the distributions have to be proportionate to ownership. Right? So if we're 50-50, any distributions have to be 50-50. With a partnership, I can do whatever we agree to. So we may have a 50-50 economic interest or a capital interest, but I may get 70% of the profits, or you may get a different percentage of the profits, and we can figure out how we allocate stuff based on what works and according to our agreement. If the IRS takes a look at, let's suppose you own a building with your son, he owns 10%, you own 90%, and you've been taking these refinanced distributions out of the S-corp, the IRS could come in and say, hey, you know, you've got an S-corp here, and you're required to handle these distributions 90-10, 90%, 10%, but you've taken 100% of the distributions, which means you're no longer an S-corporation. Now you're a C corporation. And if you're a C corporation, now you're paying double tax on everything. So S-corps are very difficult to manage in the regime of the IRS code, unless it's a pure operating company where you've got ownership and you know exactly how the profits are going to be distributed. So I had about 25 minutes, and I came in at 24 minutes. I think that is my last slide. So there's my information. I'm happy to send the presentation to anybody who would want it, and I'm happy to chat with anybody. And I guess I'll send it back to Steve.
Thank you, Paul. That was really informative and helpful. We did get a couple questions. The first one was, with the current administration talking about changing the tax code, what do you foresee being the better option from what you have presented?
So I get to put my prognostication hat on, which means whatever I say I can't be wrong, because I don't know if it's going to happen. But what I'm seeing a couple of things, and some of the reading is leading me to believe that what they want to do is they want to put pass-through entities like S corporations and LLC in parity with C corps. So what I'm expecting to see is a significant reduction in the C Corp tax rate, and then a second level of tax when the profit's distributed. I'm also thinking that what they may do is they may likewise drop the pass-through rate for pass-through entities like S corporations and LLC. If the company retains the profits, then it pays a lower rate. But if it distributes the profits, the company may pay another level of tax just to try to create parity between all these entities. And the other two things that I've kind of heard through the grapevine is they're looking at maybe eliminating the interest deduction, but allowing a much faster write-off of real estate. So my recommendation at this point, after having said all that, is the only thing I can tell you for certain is what the rules are now, and I would maintain the current course. The deals I'm getting involved with, we're not changing the way we're doing it based on speculation, because I've been doing this 30 years, and the fact is talked about in committee or you read about it in the Wall Street Journal. Until it's signed, it hasn't happened. So we're recommending no change to the current strategies, just simply because they're talking about tax reform.
Okay, great. Besides tax issues, what are some other issues we should consider when making these decisions?
Well, you got a whole bunch of issues regarding family, succession, ownership, who you're going to transfer the business to eventually, what does that plan look like? I mean, there are a whole lot of operating issues, non-competes. Do you have the management agreements drawn up properly? There's only one reason to start a business, and that's to sell it. And I tell people the best time to plan to sell your business is, like, the best time to plant a tree is 100 years ago or today. And the best time to plan to sell your business is when you start it. So when you set these up, you really need to be thinking about, okay, who's going to own this down the road? Is it going to be a family member? There are certain things you want to do if you're transferring it to a family member. Is it going to be part of your key employee group, the management company? We want to do certain things there. Is it going to be a sale to an outside third party? So each one of those requires a significant amount of work. But those are the types of things I think all business owners ought to be thinking of. My experience is that the business owners, and I deal not just in real estate but other businesses as well, they're really sharp people who start a business following a passion or a certain ability they have. They start making some pretty good money, and they lift their head up 10 years later and they think, oh God, what's next? What do I do next? And the challenge is, to be thinking about what does this business need to look like in order to maximize my dollar value when the time is right to sell. Because sometimes these windows are not open very long. They may be a 12, 18-month window when multiples get high and cash is cheap, and they kind of ebb and flow. So you just want to make sure all your ducks are in a row, to get maximum dollars when it's time to sell.
Okay. If you decided on one, can you change to the other at a later date?
That's a great question. So it is very, very easy to convert from an LLC to an S corporation. I can do that by filing a form, and boom, I'm an S corporation. If I convert from S corp to LLC, then what I've deemed to have done is I've deemed to have liquidated every asset in my S corporation and sold it to myself at fair market value. So it's not a problem as long as there's no appreciation. If I buy a widget for $100 and 10 years later I haven't done anything with it, and I'm an S corp and I want to convert to an LLC, no problem, provided the widget's still worth $100 because the transaction unwinds itself. But if I buy a building for $1 million and 6 years later it's worth $4 million, and I want to convert to an LLC, I just generated over $3 million of taxable gain because I didn't pick the right entity in the first place. Now, there are, if you've got real estate in an S corporation, I mean, this discussion would go way beyond what I'm talking about today, but you could set up LLCs underneath the S corp, create a kind of like doing a estate freeze where you freeze the value of the entity and try to get the appreciation out of the S corp. But those are some pretty sophisticated tax planning strategies. But just suffice it to say that if you go from S corp to LLC, you are paying tax on all the fair market value, goodwill built up in that entity.
Okay. Does LLC versus S corp recommendations vary by state?
I would say no, because the federal tax consequences really drive this decision. For the most part, most of the states treat them the same. The ones that don't, the difference does not outweigh the federal consequences of operating as an LLC versus an S corp. So I'm not familiar with every single state, but I'm going to be hard pressed to think of a reason why I'd be willing to assume the liability of a federal burden of all those additional taxes simply because there may be some nuance or difference in tax rate at the state level.
Okay. I'm not sure about this, but I'll go ahead and ask it. What if you are receiving TIF rebates? I'm not sure.
TIF is
They wrote TIF, but they could have. Let me see if I can.
I'm not familiar with the term TIF.
T as in Tom, I as in icicle, F as in Frank. TIF. Let's see what.
Is that like the subsidy for the redevelopment?
Yes.
Well, so if you're receiving distributions that's not considered income, but they're considered rebates, if you're an LLC, you get economic credit for all the debt in the entity. If you're an S corp, you don't. You only get economic credit for the money you put into the S corp. So if you receive these rebates in excess of your basis, they will be taxable in an S corp. As long as there is debt on the property in an LLC, they'll be tax-free.
Perfect. All right. I think that's all the questions we have at this point. So I want to again thank you, Paul, and everyone that joined us today for this very informative webinar. Again, Paul's information is here if you want to contact him. Feel free to check out our events calendar on the AHOA website for other webinars we have coming up, and also in our resource library for past webinars we have done. Everyone have a wonderful day, and I hope to see you all join us for future webinars and AHOA events. Thank you.